Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by our newest co-host.
Patrick, hi, how are you?
Pat, we're back in the recording studio once again for another episode of the podcast.
Another week, another day, another day, another dollar.
That's it. Well, this one is importantly special because it's the start of the new financial year. Mm-hmm. I can't believe we've gotten here so quickly.
Yeah, I know. It's absolutely flown by, hasn't it? This last 6 or so months. Yeah, absolutely flown by. Before we know it, we'll be at Christmas and Christmas parties and whatnot.
This is true. So this is actually a really fitting podcast. Pat, what are we talking to everybody about today?
So we're talking about setting yourself up for success for the new financial year. So doing a bit of tidy up with a few things, kind of planning out essentially the next 12 months effectively as well with the new financial year, and basically getting your ducks all lined up so that, you know, at the end of next financial year or this financial year, you're not having to worry about, you know, all the stuff that you were worrying about last financial year.
It's really interesting. And to all our accounting friends out there, I'm probably going to make a few enemies here, but all of our accounting friends that we've been talking to, they're pretty stressed leading up to the end of the financial year because they're doing their tax planning. And it makes sense because you need to look at your profit and what's happened and things like that. But from our perspective, I've always thought to myself, how come we're not starting tax planning at the start of the year rather than with a month to go at the end of the year? So that's what we're trying to achieve today and talk about some of the things that we think are pretty important and critical in terms of setting yourself up for success for the financial year ahead.
Yep, that's it.
Pat, take us into it. What's the first thing off the rank?
All right, so first thing, and this is just a bit more of a general kind of comment. I'm guilty of this in the past as well. And, you know, you have a folder somewhere that's tucked away underneath your bed that's just got full of receipts, or like a shoebox, essentially. And you kind of go, you know, you go give that to your accountant and they go, well, what am I going to do with this, right? It's really then just kind of going, hey, let's just digitize a bunch of things. And get things kind of automated, get things kind of simplified. You know, you basically take a photo, you chuck away the receipt, and away you go. So as long as everything's kind of in one place and you've got a system, it's really just about creating that system. Now, whatever works for you, it could just be, here's a shoebox, and that's fine for you, and that's, you know, as long as your account's okay with that. But we find that oftentimes there's so much technology out there that you can obviously just lean on that to kind of get you up and running with a bunch of things. So yeah, personally, I use the ATO app. I find that actually quite useful. Kind of, you know, you basically, you go to the city, go see a client, pay for parking, pay for tolls, whatever it is, chuck it in the app, and, you know, take a photo of that. Yep. You never have to worry about it again until the end of the year.
There you go. Yeah. I didn't even know that that service was available through the ATI. Yeah. What I tend to do is I've got a scanner app that I downloaded from the App Store for free on my phone. And basically what I've got is just with like Dropbox, I've got receipts for 2023, 2024. Yeah. I break it down into months and literally, like what you said, just scan that. A small change to the name so you've got an idea of what it is when you're searching through it. Yeah. And that gets a hell of a lot easier. Yeah. And we tend to do that with our business receipts as well too, just because, you know, we don't want any paper, right? So.
Yeah. We've gone paperless for the last like 3 or 4 years now, and we haven't looked back essentially. And why not do the same thing with your own personal
Makes sense. So staying organised with your paperwork, tick, really easy, great idea. Yep. What's next?
Next, and people, you know, my clients, I'm sure that they're probably sick of me saying this, but review your budget. You know, and if you don't have a budget, pull one together. Yeah. It's the simplest thing to do. It's not always the most accurate because it takes a little bit of, you know, toing and froing to kind of get it perfect. And it's taken me, you know, a number of years to kind of get it to a point where it's like, cool, it's just humming along perfectly. But the budget itself should be as accurate as possible and reflective in terms of your own spending habits and things like that. And I always say this, my budget, I can almost put it down to the dollar in terms of how much projected over the next year, how much I'll be able to save, invest, put aside whatever, money
Yep.
spend for holidays or whatever it is. You've got that kind of set aside and planned for effectively. And the budget's a living document. It just changes over time.
Yeah, and look, we often tend to sort of go into this a little bit softly and say, hey, people don't like doing their budget. And I understand it. It's mundane. It's a bit of a pain. It's a bit of a task. And probably just on that note, the difference between an aspirational budget versus an actual budget, there's a significant difference between the two.
Yep.
So it needs to be reflective of reality. But just coming back to my previous point, you need to do it in order to progress. And from our perspective, if you can't get your cash flow in surplus, which is what gets fed off your budget, then you're always going to tend to struggle if you can't get those foundations right, which is the reason why we keep going back to making sure that you review your budget or get it in place. And I tend to use a bit of a sporting analogy around a lot of these things because that's what seems to resonate with me. But if you're looking at doing a competition, what you might do is you might measure yourself in terms of, distance traveled. Maybe you're riding a bike or something like that and saying, I can do 10 kilometres in a certain period of time.
Yep.
You measure it first and then you start to improve on that. And I think it's just getting that baseline, using that sporting analogy, using a budget as well too, is getting a baseline so you can understand where you're at. And then from there, you can actually identify what needs to be improved or what needs to change.
Yeah. Yeah.
And we're quite lucky we can specifically target things if they look too high or if they look like they're out of whack. So yeah, we tend to shy away from it a fair bit, but I thought I'd just call it out because you need to do it and it does become easier over time, and then you get to the master status like Pat, and you can forecast it with a really high degree of accuracy, which is great.
Yeah, and I guess you're right, Bills. Like there is a degree of apprehension for people to sit down and actually do a budget, but it's kind of like if you're in denial about it, it's really hard to be able to plan out anything, right? So sometimes it's like a band-aid. Rip it off, do it. To sit down, spend an hour or so on a weekend and get it finalized.
Yeah.
And as long as your numbers don't change too much, you basically won't have to look at it all that often, right? So obviously now in particular, given that cost of living and mortgage repayments and things like that are going through the roof, it's probably more pertinent than ever to really just be on top of those numbers, your numbers, because everyone's numbers are going to be different, and just be on top of those, make sure that they make sense, and really just hone down and kind of tighten up the belt if you need to.
Time well spent, and that's actually a really good conduit into the next one, which is around debt management. And like you said, that's been extremely prevalent these days because we are in a really interesting time regarding interest rates. I mean, look, I was looking at it this morning, and over the financial year, we basically went from rates not existing to a substantial increase over a 12-month time frame, and that's been the fastest increase in the official cash rate in history. So debt management has been a really crucial one. Let's talk through that.
Yeah, so debt management, and I guess, we talk about good debt, bad debt in a way. At the end of the day, it's debt that you have to repay unless you want to sell the asset, whatever it is, and recoup the costs. But most of the time we kind of manage and talk to clients about, there's certain debts that you want to have and there's certain debts you want to get rid of as quickly as possible, right? And the biggest one for most people is really home mortgage debt, right? So it's a chunk of change that goes towards paying down debt. Oftentimes $400,000-$600,000, and obviously that has been a significant cash flow burden for a lot of people over the last 12 months.
Yep.
So we talk about trying to minimize that and utilizing the banking system or structure in place. So offset accounts, redraws, whatever it is, consolidating them in such a way that you're not paying as much debt as also much interest on that debt as possible. But certainly kind of try to get rid of that as quickly as possible. And then that's, talking about bad debt as well, like credit cards, personal loans, car loans, that kind of stuff. Debts you can't take to your accountant at the end of the tax year and go, hey, I want to claim the tax back or the interest on this back. That's bad debt. So we want to get rid of that as quickly as possible. And generally speaking, that's higher than other debts, other forms of debts as well. So definitely a case of trying to chip away at that as quickly as possible. Yeah,
and the consumer debt one, I think that's really easy. Most people tend to understand and resonate with that. Credit card debt's bad, car loan debts are bad, payday lenders and the like. So I get those. I guess just going back to your point about the mortgage, because it's such a large, for the majority of people, because it's such a large amount of debt and you've got it for such a long period of time, you tend to not necessarily neglect it as much, but if you're not on a competitive interest rate, I think it's an easy one for it to slip through. And maybe, only review it every 4 years or every 5 years and you go, hang on a sec, maybe I just need to pulse check it. But ensuring that you're on a competitive interest rate and using the banking structure, like you said, offset accounts, increase the frequency of your repayments and so on and so forth, it makes a significant difference over the period of the life of the loan. Maybe you take it from a 30-year term to a 25 just by taking advantage of some of those things, and maybe you're saving tens of hundreds of thousands of dollars in interest as well too. So on that one, and that's been one of the positives out of the increasing interest rates, that I think people are more in tune with their mortgage because they've seen their repayments go from this to that, and it's been quite a sudden jump. So definitely can't downplay that. But in my mind, the debt management piece is definitely around the mortgage, and I think that's probably the biggest one that attracts the most amount of attention, and that's almost in my mind kind of like the low-hanging fruit.
No, definitely. You want to, obviously that's the biggest burden for a lot of people these days as well, in terms of that sudden increase in repayments on the home loan.
Pat, what about investment strategy?
So kind of the flip side to this. So essentially, you get your debt management under control, and you're comfortable with your debts and what they look like, and you've got a clear kind of exit strategy, so to speak, in terms of when you'll be finalised with that debt. So this kind of comes into play with about retirement planning and a few other bits and pieces as well. But essentially, the flip side to the debt conversation is then going, okay, well, what else? I've got a surplus now. What can I do with that surplus? What should I be doing with that, generally speaking? And so, one of the things we're big advocates of this is obviously putting your money aside, getting your money to work as hard as it can for you, meaning that it's earning a reasonable rate of return over a period of time, and above, obviously, inflation rate as well. So that's probably the other key part to it, because, we're talking about 10 plus years ago, people could retire comfortably on just interest, like bank interest alone. You have a couple $100,000, put that in the bank, and away you go, and you live off that interest. Over the last 10 years, we haven't seen that. And now it's starting to come back into flavor again in terms of the interest increased into the banking interest increasing. But even then, it's probably not enough, particularly with inflation being as high as it has been. Putting money into a term deposit, bank account, whatever, still yielding lower than inflation. So don't forget, inflation is the time and tested eroder of assets, essentially.
Well, you have to invest your money in order to just keep pace with inflation, but you need to beat it as well. But it's interesting. The good old term deposits are starting to come back into fashion as well. Just on that investment strategy piece, and we were sort of tying into the budget. I had a conversation with a client earlier in the week, and we were talking about, they had young children, and we were talking about a particular strategy. And we spoke about it, Andrew and I, on the podcast a few weeks back. But in terms of being able to get their children in a position to set them up financially, and what that meant for them is getting them to a position when they're in their early-ish 20s to be able to get them a deposit for a house. And essentially what it was is, if this is your goal, whatever that looks like, and it's important enough to you, then you have a trade-off discussion and say, okay, there's no room in the budget at the moment because, whatever. But if this is important enough to you, reverse engineer it, figure out how much you need to contribute into a particular investment, and then you say, okay, is that important enough for you to then offset? And let's just pick some numbers out of thin air. Let's say it's $100 a week, right? If it's something that's important to you enough, what can you forego in your budget that equates to $100 a week in order to achieve that goal? So it's not just, hey, we've got a surplus, what do we do with it? It could also be, hey, there's something that's really important in our lives that we want to aim for. And, we see that all the time with people sort of downgrading their day-to-day lifestyle because they're saving up to go on a holiday. And that's perfectly fine because that's the thing that's important to them. So, I just thought I'd add that on the investment front.
Yeah, absolutely. But I guess, obviously, with the investment side of things, there's a million ways to skin that cat. So, obviously seek professional help and get some guidance in terms of what that looks like, because there's, like I said, there's different ways to do it. And certainly different pitfalls along the way as well if you're not diligent with it. And be quite specific in terms of your timeframes, because that's probably the other part of an investment strategy, being mindful of, am I investing for a year, or am I investing for 10 years or 30 years? Because each one of those stage gates along the way is going to dictate a different strategy effectively. So, if you're talking about superannuation, that's a 30 plus year thing. If you're talking about, something for over the next 12 months, maybe investments in putting money aside in that sense is not the right strategy, and that's fine, no issues with that. But just be diligent with what your timeframes are as well, realistically. Yep.
What about from an insurance perspective? Because that's always a really big thing in the household budget as an expenditure item.
No, absolutely. So we're talking personal insurance, we're talking home contents insurance, we're talking car insurance itself as well. So a myriad of different insurances, of health insurance.
Pet insurance. I heard about that one recently.
Yeah, so
getting quite expensive.
A bunch of different types of covers out there, and they all obviously do different things. They all have a specific purpose as well. There's no one-size-fits-all approach with insurances. But we always find that it's important to reassess your insurance cover over time, because the creep that tends to happen with insurances just naturally just happens in the background, and you get a letter in the post, or nowadays an email, and saying, "Hey, by the way, Bills, your insurance premiums are going up to X amount this year because of inflation, or cost of whatever."
Yep.
And it all adds up. It's kind of like that the frog in the boiling water, right? Or the slowly simmering water that you forget that it's
an increase of about 20% each year. I think that's what I've been averaging when that comes in. I don't know if it's the frog in the warming water or the boiling water where it gets warmer and warmer slowly, and then eventually it boils. It goes from cold to hot pretty quickly.
Yeah, no, definitely. Yeah, but so definitely have a look at your insurances, understand, I guess, what you're covered for as well. That's probably the other flip side to it, because sometimes you think, I'm covered for, let's say home and contents insurance, and you didn't realize, by the way, fire and theft weren't covered as part of your policy, or whatever. So definitely make sure that you understand the nuts and bolts of it, because sometimes you think you're covered for something and you're not, and sometimes vice versa, you're over covered for something and you probably don't need it.
Yeah.
Health insurance is that perfect example. Sometimes people who are in their 50s and you still got child healthcare insurance and
cover for pregnancy and things.
Don't need it, right?
Yep. Yeah, and I guess just on that note, what I found has been really beneficial in my experience with that, because reviewing it, unless you're committed and unless the dollar saving is there, it's a very difficult exercise, and it's like pulling teeth. Starts with a phone call. Just pick them up. Say, hey, is it competitive? Threaten to leave. Nothing gained, nothing lost by asking for a discount, right? Yeah, exactly. The worst that they can do is say no, and the best is that they give you a discount and you end up paying for less. So, yep. What do we got next, Pat?
So emergency fund, probably kind of skip this one, but emergency fund is probably one of those ones where, out of the back of the budget, making sure you've got a surplus to rely upon just in case, when stuff hits the fan. So you've got funds set aside, and there's no one size fits all approach with this. It's my general rule of thumb is 3 to 6 months worth of living costs, essentially. So allocate whatever that is. I'm going to use nice simple numbers. If it's $10,000 a month that you and your family are spending, set aside either between $30,000 and $60,000. That should be in an account that you've got access to, but probably shouldn't be that visible. Something that you kind of just almost squirrel away for yourself, so that you're not tempted to utilize it as well. I get clients asking me, should I put in my offset account? That's certainly an option, and it's probably better than, once again, bank interest these days, but something that you're not tempted to tap into unless you absolutely have to. So, a refrigerator breaking down and things like that probably shouldn't qualify. It's more a case of you lose your job and you need to find something reasonably quickly, and you're the main breadwinner of the family.
Yeah, so that's actually a good segue into how we think about the difference between, because 3 to 6 months is quite a range. And using that example, the difference between having $30,000 on the lower end versus $60,000 on the higher end is quite significant. And whenever I have these conversations with people, I'm always pretty specific around why there's a difference. And some of the things that we think about is, I guess from an employment perspective. So if you're in an occupation where maybe you've been with your employer for a long period of time, you've got annual leave, you've got sick leave, maybe you've got access to some long service, job security is quite high, you could probably say, okay, I'm comfortable enough on the lower end of that 3 to 6 month scale because of all of those other things that we were talking about. Versus if you've just started a job and you're on probation, you don't have any entitlements built up, you're not sure where you sit, it probably needs to be on the other end. And it gets a little bit more complicated when you've got two members of the household, because you kind of need to, or two income earners in the household, because you need to combine that and say, okay, on balance, where do we think this sits? And a lot of the time when you go through that and have that conversation with people, that tends to resonate, and they then say, okay, yeah, you're right. Based on what you've told us, actually, I think it probably needs to sit at the top end for us, or somewhere in the middle we're comfortable with, or no, I've been with my employer for ages, the business is solid, no problem, I'm happy with that, away you go. So yeah, that's a little bit more clarity around that 3 to 6 months, because that's some of the questions that I get about it.
And once again, employment occupation status as well. Like if you're a contractor, tend to kind of change jobs as often as you change undies, so they tend to move around a fair bit. So obviously for someone like that, and if you're a contractor as well, you're usually the last person in, first person out as well if something happens with the business. So they're the ones that oftentimes we kind of err on the side of caution with this, just because they change jobs so all that often.
Pat, superannuation, it's always a good time to look at that at the start of the financial year.
And there's been a bunch of changes to superannuation as well, and certainly some proposed changes out of the back of the budget back in May. Some of those are still pending, so we don't know if they'll land yet, but we'll chat through some of those ones today. Obviously, one of the big ones is talking about contribution caps as well. So this is obviously something that we're quite we're big advocates of. Saves you tax going into superannuation, builds up a nest egg as well. You're not going to have to worry about retirement planning and things like that if you get it right. But obviously you don't want to go over those caps as well, because there's big penalties out of the back of that. So there's, for anyone who doesn't know, there's two types of contributions: pre-tax, post-tax, or concessional and non-concessional contributions. Concessional, so in pre-tax dollars, is basically a conversation you have with HR, payroll. Hey, can you divert $100 to my, superannuation, whatever that is. 27,500 is the magic number every financial year. So basically 1 July all the way through. That's the cap that most people aim towards. And usually there's a bit of a mad run to kind of contribute X amount into superannuation beforehand, because you depending on what it is, you may be able to claim a tax deduction on contributions as well. But 27,500, but be mindful that also includes your employer contributions. So if you're on, I'm going to keep my math simple here, you're on about 100, your employers are putting in, let's say 10,000 into superannuation, you have discretionally another 17,500. So I guess where that has an impact is really two things. So this financial year, 1st of July, super guarantee contribution. So what your employee is putting into super is increasing from 10.5% to 11%. And if you're on a salary sacrifice arrangement, which is what you voluntarily put into superannuation pre-tax to get to that cap of 27,500, just reviewing that and forecasting that out for the entire year and saying, hey, where is that going to put me? You obviously need to take into account the fact that the SGC rate has gone up, and if your pay has changed, obviously the amount going into super has changed as well too. So it's always a good time to look at your salary sacrifice arrangements, because you don't want to breach that. You don't want to breach that cap. And the other thing probably just to be mindful of as well, if you do get any bonuses throughout the year. So there's a incentive at the end of the calendar year or financial year or whatever it is to go, hey, here's an extra bit of money to job well done for the year or whatever it is. That is also a portion of that is set aside for superannuation. So if you do get a bonus, a chunk of change towards whatever, make sure that you set a bit of a buffer so that you don't go over those caps as well.
Yep. There's also the carry forward contribution option as well too. So if you haven't used your cap in previous financial years from the 18-19 year forward and your balance is below $500,000, you can actually use up some of that cap. So that's really just designed to try and get more people to put more money into superannuation to save for their retirement. So that's really, I think, from my perspective, a cash flow play. And I tend to think it's easier looking at that over a 12-month time frame and saying, yep, I'm going to put in a little bit of extra over a 12-month period of time, as opposed to, hey, I'm going to get to June of next year and then I'm going to put in a lump sum depending on where I'm at. But that's just me.
Yeah, absolutely.
Yep. And you said the other cap as well too, Pat?
Yeah, so post-tax or non-concessional caps, they've gone up over the last couple of years, but essentially now it's $110,000 every financial year. There's bring forward rules and a few other bits and pieces we can chat through in a sec, but essentially $110,000, you've paid the tax effectively. It's sitting in your bank account and you're just going, here's a chunk of change that you can put into superannuation. There's no tax deductions on these contributions there, but the idea is that you're using that money to top up superannuation in anticipation for retirement planning. Could be in a couple of years' time, could be in a number of years' time, but essentially you're basically putting a little bit extra aside into super there. What we tend to see happen oftentimes is people sell a home, downsize, sell investment property, sell some assets, whatever it is, or they've come into an inheritance as well. They basically just need to add a little bit extra to get them back on track with retirement planning. And so sometimes it's a play to actually put a little bit extra into superannuation. There's other caps, just to make it all much more confusing. So if you've been living in your principal place of residence, you downsize, there's a downsizer cap, and that's different to this cap again. $300,000 per person. So for a couple, you can actually put in $600,000 collectively, but $300,000 there. But just be mindful, there's different rules around this. So just check with your advisor, check with your accountants if you need to, because you definitely don't want to trip this up. Then I guess with the contribution, the non-concessional cap, you can also use up to 330. So basically 3 times the 1 year cap, and bring that forward. So you basically use up 3 years worth of caps in 1 year, get that into the superannuation environment in that year, and then basically eliminate the next 2 years worth of contributions as well.
No, and I think just on that super note, I mean, we talk about that a lot, really for a couple of things. One, because it's such a good tax minimisation vehicle. If you're doing it from a concessional perspective. But the other thing too is that every time we've run simulations, you can't beat the superannuation environment when you're in drawdown phase. So there's no tax on earnings, there's no tax on income. So if you're at a particular age where you're drawing down superannuation money as a pension to pay for your lifestyle or to fund your lifestyle, you're not paying any tax. So you can't beat that. So we always encourage that that's the end state. That's absolutely perfect because you don't have to factor in tax. So looking at that, I think it's always a good opportunity at the start of the financial year, just taking stock and saying, hey, I am X amount of years of age now. I anticipate that I'm going to finish work by the time I'm Y, whatever that number is. We're not going to throw any numbers in there around me because I've made a decision that I'm not a day over 39, Pat. And I'm sticking with that for forever. But basically looking at how much time you've got, looking at how much money you've got in there, looking at what you're contributing, and then projecting forward and saying, hey, if I maintain the status quo, is it going to be enough? If it is, fantastic, you just maintain that and monitor it. If it's not, what are the things that you need to do in order to change that? And the longer amount of time that you've got in order to do that, obviously the better probability that you're going to get a positive result out of the back of it.
And you definitely don't want to leave it to too late, particularly if you're in a fairly heavy manual role, so I'm thinking concreters, tradies, that kind of thing, or even nurses to some extent as well. Like, if you're on your feet all day, every day, and you're going, geez, I don't know if my body's going to last, until I'm 65 or 67 or whatever the number is for you, and I need to retire kind of yesterday, you probably should be planning further ahead because you definitely don't want to get to a point where you're going, what, I've done my back, I can't work anymore, and I'm forced to retire, because that's a completely different kettle of fish as well.
I think that probably sums up most of that, and probably just to tie a bow around it, I think it's just part of setting your goals. So set your goals for the future, for the year ahead, figure out what you need to do, try and optimize your position, reverse engineer it, work backwards, and that's pretty much how it works.
Yeah. And I guess, I don't know how you do it, Bills, but certainly for myself, I kind of do like a twice a year kind of check in with myself, with my partner, and go, okay, what do we want to do for the next 6 to 12 months? Some of those goals could be longer, and that's fine as well. So we might plan out, are we still on track, or do we still want to do that goal as well? Is probably another thing just to double back to. But set yourself some lofty targets. See if you can get to that point, and if you're 80% there, you're probably still better off than not planning at all, right?
100%. Yeah. Pat, well said, well summarised. Thanks for today. To our listeners and our viewers, thank you for your time and taking the time out to listen to the podcast or watching the video. Pat, thanks once again.
No worries. Thanks for having us.
And we'll catch you on the next one.
Thanks, guys.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.